Now, at some point between now and when you retire, there's likely to be a 10-day period that's going to decide if you retire with the income you want or half the income you want. 10 days that can halve the income you've got in retirement. The problem is nobody knows when these 10 days are going to come. But the actions you take over these 10 days is ultimately going to decide if you can retire when you want with the income you want. So in this video, I'm going to explain exactly what this means and how you can actually ensure you don't make the wrong decisions over those 10 days. But if you're new here, my name's Ben, and I've worked in financial advice for the last 10 years. And my aim is to help as many people as possible gain more clarity and confidence around their personal finances, but specifically their retirement plan. Now, if you're aged between 40 and 55, the chances are that at some point over the last 5 to 10 years, you've seen markets falling and thought, you know what, I'm going to move my money out of the market into cash. And then when markets have settled down, I'm going to reinvest that money. Now, clearly on the face of it, this sounds like a very sensible option. Take your money out, put it in cash for the time being, and then reinvest that money when markets have settled down. But the problem is this is nearly impossible to do. And anyone that tells you otherwise is quite frankly lying to you. And the data I'm going to show you actually backs this up and shows you how much of an impact it can have moving your money out of the market and into cash when markets are more volatile. Okay, so let me explain this in a bit more detail and put some numbers around how much of a mistake this can be moving into cash during times of volatility. So on screen now, you can see data from JP Morgan dated between 2004 and 2023. So a 20-year time horizon. And you can see that over that period of time, if you'd stayed fully invested in the stock market, you would have achieved an annual return of 9.7%. So this is great, and this is exactly the sort of return you would expect on average over a long-term time horizon. But the problem is, what if you went into cash during that time frame? So you can see on screen now what would happen to your annual return if you'd missed the best 10 days of returns over the last 20 years. And you can see that annual return has nearly halved from 9.7% to 5.5%. So this really shows you the impact of missing those 10 best days. Now, a conversation I have with a lot of people is around, is it actually possible to time the market? Because you might be sitting there thinking, okay, well, I may miss some of the best days. I may miss the 10 best days, but ultimately, if I'm selling soon enough, I can actually get out the market and stop my pension dropping as much. So what does that actually mean and how difficult is that actually to do? So on screen now, I've put every trading day throughout 2020. And as we all know, 2020 was a very volatile time due to coronavirus. But you can see that I've highlighted two periods here, one in March 2020 and one in November 2020. And what this shows you is that quite often, the best days in the market in terms of returns often follow the worst days. So this is why it's really difficult to time the market, because by the time you've sold your money into cash, trying to then reinvest that money at the optimal time is often likely to mean that you're going to miss out on the best days. And as we've just seen, the impact of this can be huge. So going back to the percentages I mentioned earlier in terms of the annual returns, that 9.7% if you'd stayed fully invested versus that 5.5% if you'd sold and missed the 10 best days over the course of 20 years. And again, that's only one day every 2 years you've missed out. How much of a difference can that make not only on your pension pot size at retirement, but also the annual income you could expect from that pension throughout your retirement? So you can see here, I've mapped out that 9.7% and that 5.5% annual return. And this is based on a 40-year-old retiring at age 60 over a 20-year time horizon. So you can see that if you'd managed to get that 9.7% return and stayed fully invested for those 20 years, you would have had a pension pot of nearly £1 million at age 60. However, if you tried to time the market and missed the 10 best days over the course of that 20 years, you would have nearly half that amount. And if we then actually convert that into the annual income you could expect in both of those situations, you can see that if you stayed fully invested with that nearly £1 million pension pot, you could achieve an annual income from that pension pot throughout retirement of about £43,600. Conversely, if you'd missed those 10 best days, the annual income your pension could produce is about £22,500. So you can see how much of an impact missing those 10 best days can actually have not only on your pension pot size, but also the income that can actually produce for you throughout retirement. Okay, so what would I suggest to anyone in this situation? Now, first, you need to accept that nobody can call the bottom, including you. The JP Morgan data we went through makes this concrete. If the best days cluster right after the worst ones, then I'll get back in once it's obviously turned around, guarantees you miss those exact days that matter the most. There's no version of this strategy that works reliably. The second is to separate your timeline from your reaction. If you're not touching this money for 10, 15, 20 years, a bad month, even a genuinely awful month, is noise on the chart you'll be looking at in a decade. The third is if you're going to make changes, make them on a schedule, not a headline. A planned annual review of your allocation is a completely different thing from an emotional decision made the week markets are falling. And the fourth is if you are within 10 years of needing this money, this is genuinely the point where your allocation should start shifting to reduce volatility. Not because markets are scary, but because your timeline has changed. That's a planned de-risking process, not a panic move. Now here's the thing. Nobody can tell you when those 10 days are going to be. Not fund managers, not analysts, and nobody on YouTube, including me. The thing you need to be doing is riding that volatility out and accepting that you cannot time when the bottom of the market is going to be. And as we've just seen, if you do try to do that and get it wrong, it can have a huge impact on your retirement plan. And if you want to run your numbers and see if you are on track to retire with the income you want when you want, what I would suggest you do is use my free retirement calculator. And you can find the link to this in the description below. Now, what this allows you to do is you can go on and input your own details. So your current age, your current pension pot, how much you're contributing to your pension, and roughly when you want to retire and what income you want. And what the calculator does is using a broad set of assumptions is it will show you if you are on track to retire when you want to with the income you want. Anyway, hope you've enjoyed the video and got some value from it. If you did, please do consider subscribing for more videos just like this in the future. And hopefully I'll see you in the next video.